Hi, thanks so much for joining in. You're watching Ask Profit on NDTV Profit. My name is Mathew. With me is Mahima Vachhrajani, and we will take you through the next 1 hour of trade. Let's take a very quick look of where the market is right now. And you have the Nifty 50 that has come off the low point of the day, and it is trading with cuts of just about 0.1% right now, and above the 24,700 mark. Some support being found at those levels. Even the broader markets have recovered quite smartly from the low point of the day, and you have the mid-cap index that's down about 0.3%, the small-cap index that's down only about 0.5% or thereabouts. Still, quite a bit of selling is in evidence, and seemingly the foreign institutional investors have not stopped. Perhaps you might see a change in tide just purely on the back of the Hyundai IPO, but largely they've been net sellers all of this month so far, and quite considerable net sellers at that, to the extent of over 70,000 crore. Now, take a look at the sectors that are contributing to where we stand right now, and you see significant underperformance in the way of the IT index, which is dragging in trade today. It's the worst performer, down about 1.8%. On the top, though, you have the private banking index, primarily on account of Axis Bank, which is doing quite well, and you have Nifty Metal as well as Auto that are gaining. You also have the Nifty Bank that is holding on with gains of about 0.5%. Let's very quickly take you through a few stocks that we should watch out for, and Mahima has got the list to focus on.
Right, Alex. So to start with, I'll start with the gas stocks. They're pretty much under pressure today, both in the Prastha Gas as well as Mahanagar Gas and Gujarat Gas are under selling pressure. Now, this is after India's city gas distribution sector is facing challenges, and all of these companies have put out on their exchanges the impact of this, and it can go to up to 20% cut in overall gas allocation. So all of these companies are under pressure. Next one is Zomato, where it's considering QIP, and the stock is under pressure on the back of this. The company already is sitting on a cash, or significant cash of 12,500, and yet looking for fundraise, which is why the stock has taken a hit today, down around 4% almost. Let's also pull up something like Polycab and see what it's doing in trade today. Well, revenue was good, but margins have taken a significant hit. Now, this is because a couple of things. They have higher B2B mix. Their mix from exports has gone down from 9% to 6%. And overall, it continues to invest in brand building, which is why the margins have taken significant hit. Let's also pull up Quick Heal. Quick Heal is also seeing significant selling today, again on the back of its Q2 earnings, where revenue was down around 6%, EBITDA down 73%. Margins have come down to 4.2% from the 14% mark, and PAT down almost 68%. And the stock has, however, recovered a slight bit, but the stock is still under pressure, down around 5% as we speak. But the main focus today, Alex, on the show is Manappuram Finance, and we have Harsh joining in with more detail as to why the stock has tanked so much. Harsh.
Embargo on their MFI portfolio with regard to disbursements. That's huge, because 25% is the size of their MFI book versus their total book. So nearly a quarter of their book completely halting in terms of disbursements. Now, the other key thing to note here is it's a faster repayment book, and therefore in the next 12 to 18 months, likely all the loans will get repaid. And generally, these embargoes take 6 to 12 months to resolve at the very least. Something like an IIFL took 6 months to resolve. And therefore, really the question is, how quickly can they resolve this, and how quickly can they start churning growth on this front? The other thing, of course, it's come at a time when asset quality challenges are significant in this particular space. We've had various MFIs come out and talk about asset quality challenges. We've seen growth starting to taper in some of those MFIs as well. And therefore, it comes at a time also when asset quality challenges are coming through. Will they require a fundraise? Won't they? They had filed for a draft red herring prospectus for IPO. In fact, in April of this year, it's not sailed through yet, and now unlikely to go through either. Will the parent fund Asirvad Microfinance, which is Manappuram, fund them? And that's why you're seeing that kind of reaction on the stock price. Brokerages reducing their EPS estimates by anything between 11 to 30% over the next 3 years. Of course, someone like a JP Morgan doing 11 to 19% of EPS cuts, and then you have Morgan Stanley doing 20% for FY25 and 30% for FY26-27. So you're seeing significant cuts, of possible funding issue as well as asset quality challenges along with this embargo, clearly causing a drag on the stock.
All right, thanks so much, Harsh, for getting us those details. On that note, let's bring in our experts. We've got Rajat Bose, SEBI-registered research analyst, and Sameer Dalal, Natwar of Natwar Lal and Sons Stockbrokers, joining in. Sameer and Rajat, thanks so much as always for taking the time. Good morning to you. I'll come very quickly to you, Sameer, on this. Manappuram Finance not doing too well today. In fact, has not done too well. If I'm looking at the year-to-date performances, erased all of its gains practically today, right? So what would you say about the latest developments, and what do you say to investors that are holding, that are contemplating this?
So definitely a very negative news flow that has come, right, from Manappuram, because like you said, like your analyst have said, that 25% of their book is not going to grow. Now, obviously the slack has to be picked up by the other businesses, but in the gold business, if you realize, they have actually slowed down the disbursements because the spreads were not coming as they wanted, because competition in that space had increased. So now either they take a hit on their NIMs and start growing that book a little more aggressive to ensure that the overall loan book does not grow, or they start seeing negative growth in their overall loan books, or flattish to slightly negative, because the other businesses can scale up a little bit, which is the housing and the vehicle. Rightfully said that there was a big value unlocking coming in Manappuram because of the Ashirwad IPO. Of course, now that's off. But one advantage is that since they don't need to grow their loan book, because they're not allowed to grow their loan book, the funding is not required. So as per me, I don't think Manappuram is going to have to put in additional capital into Ashirwad Microfinance in the near term, given the fact that there's going to be no growth in that book. Yes, it's going to take them 6 months to maybe 9 months to probably come back, but I believe they will be able to come back. They've had challenges in the past. So someone who has maybe a 3-year view can take a view and say, okay, I don't mind investing. But someone who's got a slightly shorter term view, I think the stock is going to underperform for a short bit of time. You could probably see it languishing around these levels. I don't see too much downside from the current level, for the simple reason that, look, the other businesses are still profitable and overall the business is still growing. I mean, the vehicle finance business, the housing finance business, the gold loan business is growing, but at a slow pace. So those businesses will continue to be profitable. So I don't think downside is there, but yes, in the near term, upside is definitely there.
Okay, fantastic. All right, so that addresses the focus of today. Of course, there are several other stocks that are also buzzing. We will refer to them over the course of the program, and particularly towards the end. But let's jump into the queries. And by the way, if you're writing in for the first time, that number is where you send your questions to us. If you are messaging us for the first time, tell us your name as well as where you're tuning in from, and that'll help you identify when we're taking your question. The first question is on Exide Industries, and this is coming from Punjab. Bhojraj is writing about this. He's bought at levels of 541. He's got 200 shares, which he has purchased in slightly elevated levels. The stock is currently trading sub 500, and it has not done too much, I would think, since July of this year, when it gave up those levels. Rajat, what would you say on the charts?
Look, today it is forming a hammer line after 4 consecutive sessions of fall from higher levels. So maybe there would be a bounce back in the short term. But if I look at the overall picture, that is, say, how things panned out since, say, middle of April till current date, that is actually a distribution pattern. And this distribution pattern suggests that once the 200-day exponential moving average, which is currently at 444, let's take it as 440. If 440 gets taken out decisively, then the stock is going to fall much further, because the whole pattern of distribution, once the supplies are already, whatever demand at these levels are already absorbed, and after that it starts going down, then it will definitely fall below the 200-day. So I suggest getting out of it, not remaining in it, because it may give a small jump, but not much. So it would be better to exit this stock at current levels.
Got it. So that's the view coming in on Exide. The next question is from Arunachalam. She wants to know the correct time and value to buy Canara Bank. Her question also says that whether she should wait for more correction going forward. If you can pull up Canara Bank chart, 6 months it's been down around 12% so far. So Rajat, I'll come to you for this one. What's the right time to enter Canara Bank?
Canada Bank, again, it's a case for distribution over the last, say, in this case, it is even beyond April. It is April, say, in this financial year, it has posted a top around, say, 125 to about 130. After that, it has started coming down. Now it is trading below its 200-day exponential moving average, and this is the second breach. That is, or rather, the third breach in, say, 2 months' time. And once it starts falling, and first you have to see whether it crosses 104 or not. If 104 is taken out, then the next level to watch out for would be 110. If this supply zone is taken out on the upside, then there will be a recovery. Otherwise, Canada Bank is likely to come down. Where it can go down to 92 to 88 would be the target. So if I were in his shoes, or her shoes, I don't know the gender, I would not really buy into it. Or if I'm holding, I would rather exit from this stock because its downtrend is not showing any signal that I would say that immediately a reversal is going to happen.
Fair point. All right. Tamil Selvan from France has got the next question. He is referring, interestingly, Samir, to and the words he's using, a cat on wall market situation. I haven't heard about this particular description for a market. I have heard of dead cat bounce. But he's, I asked him what he means by this, and he says that he's talking about a market that is not clear in direction because foreign institutions are selling and the geopolitical situation is unclear. What he's asking is whether swing trades are possible in this kind of a market situation. He's also specifically talking about the rubber sector and whether or not you would buy into tire companies based on what is happening with the underlying commodity.
So swing trades are definitely possible in this market, right? You're going to get a lot of volatility, and that volatility allows you to take those positions. When you get a big drop down, you can probably get in long. You'll get a bounce, you can trade out of it, and you can do all of those things in this kind of. If you're looking for a directional market, this is not the time for it. Where she rightfully said, because there is geopolitical uncertainty, right? The FI selling is also primarily for the geopolitical uncertainty. Now, coming to the question regarding tire sector, I think if you have a long-term view on tire sector, it's a great investment because, we've discussed this in the past. You might have CNG cars, petrol cars, diesel cars, electric vehicles, hydrogen vehicles, but at the end of the day, all of them are going to need tires. So if you don't want to take a play on which segment of the market is going to see the growth, will it be electric, will it be hydrogen or whatever, the best way to play the sector is an auto ancillary, which would benefit for growth of the industry. And tire factors into that. Secondly, the tire sector also has not only OEMs, but also a huge replacement market, right? So as the number of cars on the road keep increasing, these tires need to be changed every 40 to 50,000 kilometers. So as that number keeps getting larger, the replacement number also keeps getting larger, where they are more profitable compared to selling to OEMs. So I do believe that the tire industry is something one can look at from a long-term perspective. Only thing is, in the near term, we've already seen a bit of a run-up in all of these tire sectors, be it Apollo tires, be it an MRF. Of course, they've corrected a little bit from the top, but the correction has not been meaningful. So if we get another 5 to 10%, maybe even 15% correction, I think a lot of them could become great long-term investments. But like I said, I would like to buy them on corrections, not right away.
Got it. The next question is from Rajesh, who's from Andhra Pradesh. His question is on IEX. Now, he's bought IEX stocks at 220 per share. He's not mentioned the quantity, but he's asking whether it's good to hold them, sell them, or buy in recent dips. So, Samir, I'll come to you again for this one. What should be the strategy for IEX?
So I'm personally very bullish, and let me add on that I already have a holding in IEX, and the reason is very simple, that the trades that are happening for electricity on the exchange platform are only about 6 to 7%. globally they go as high as 60%, 70%, right? Now, I agree that there's market coupling, which the government is talking of, is going to come through, and which is why we've seen a correction in the stock. And I'm guessing your viewers bought it, just before the announcement came out. That's why he's got it at a higher price. Market coupling will definitely reduce the concentration that IEX has of the current market, where they control about 95 to 96% of the overall market. That will come down. But the market is going to grow. So if the market continues to grow, which we believe it will happen over the next many years, IEX again is a very low capital investment requirement business. The return on capital, return on equities are very high. Operating leverages are very high. So as the overall volume grows, it's better to have 60% of maybe 200 than having 90% of 80. And that is the situation we are in at the moment. So we will see growth. It will be slightly slower growth. So again, a long-term great buy. Corrections are great buying opportunities and adding on to your position. And like I said, I already own the stock, and on corrections, I would like to add on as well. So keep that in mind, and please make your investments.
Okay, a very quick follow-up on that. What level, according to you, is good for accumulating at least over the next couple of months?
So it's difficult to tell where the stock would stop correcting, but I would think anywhere between 150 to 170 are a good price to buy. So maybe another 5 to 7% correction for IEX may throw out a good buying opportunity. Even at 180, if you'd like to add a little, I don't think it's a problem, but I would like to have the bigger chunk coming in closer to 160, 170 levels.
All right. So the next counter we're talking about is IRFC, and this is a counter that has done incredibly well in the year to date. However, it has given up a little bit of ground from the higher levels of 216 or so that was seen in July of this year. It's still up about 47% in the year to date. This is a question from Dino, and Dino is writing in from Kerala. He's asking whether or not it makes sense to buy into this counter right now. Rajat, it's down about 28% right now. Would you say that it can be bought?
It is still in a downtrend, and the downtrend seems to be pretty strong. So probably it could go down further because it is testing the 50-week moving average, and it is trading below that. We can wait. I mean, a very safe area to buy would be anywhere between, say, 120 and 130. If one waits for some time, then I think one can buy into it. But one caveat here, Alex, that is, this stock has had a parabolic run, though it has seen some corrections. And again, currently it is seeing some corrections. So anybody getting into this as and taking it as an investment would have to wait for quite some time before any stellar returns happen. Because people are jumping into these kind of stocks because over the last 1 or 2 years, these stocks have given real stellar returns. But that thing is unlikely to be repeated so soon.
Right. Well, that's the view coming in for IRFC. The next question is from Priya, and she's in a bit of dilemma as to JSW Energy, and she's bought a few, she's not mentioned the quantity yet, but she's bought it at a price of 783 a piece, and her question is whether she should hold, sell or average, please. Now, in the past 6 months, the stock has not done much. It's been up around 7%. YTD, however, it's been up around 64%. So, Samir, how does JSW Energy look on charts to you?
So, I don't look at the charts, but that question could go to Rajat. I mean, if you want the fundamental view, I'm happy to share.
You can give the fundamental view.
So I do believe that we are in a situation where the power sector is going to do really well. JSW Energy has huge expansion plans lined up for their renewable energy space. We believe that part of the business will continue to scale up very fast, very quickly, very nicely, and start adding to the profitability. Now, this is a correction, of course, that's happened because the stock had run up far more than what the immediate fundamentals required. So they're factoring in, people are starting to talk about FY27 and FY28 when you talk about power companies because of what capacities they will have and how much profitability they will have. So on a long-term view, I would say it's a good buy. But given the fact that it ran up more than what it should have in the near term, I wouldn't put it past that we could see a further slide in the stock in the near term. But you can start adding in smaller quantities from now because given the kind of fund flow that is there in the mutual fund space, they are looking for quality companies which could generate good cash flows. And I think JSW's Energy is one of them. So I would start adding slowly from now and keep averaging as it goes down. I believe the prospects for the next 3 years are very strong.
Sameer, I'm coming back to you. Gautam from Mumbai is asking about a counter that I was looking at, ABFRL, which is Aditya Birla Fashion and Retail. Incidentally, it was because I was having a conversation recently about, okay, help me out here. The absolutely iconic, famous designer, fashion designer. Thank you, Sabyasachi. see, I don't know. She knows, and a lot of other people know. I was trying to figure out the name. Sameer, see, Sabyasachi, there is a tie-up, right? If I'm not mistaken, and there are several other brands that ABFRL is handling as well. And the person I spoke to was quite bullish on this counter, saying that there's a lot that is on the cards despite the fact that the company, the stock, is up as much as 50%. Would you buy at this juncture, though?
Looking at the pure fundamentals and what the earnings are throwing out, no, I would not be buying it. Simply put, look, at the end of the day, they're following a very similar business model to Trent also. Apart, of course, they have the other part of the business, which is this tie-ups with these large designers, which can scale up, which is a premiumized product. But if you talk about the mass market, which is what ABFRL has, the Pantaloon brand, and they're scaling up, they've not been able to do what Trent has been able to do. They've not got the operating leverage. They've not got the footfalls. They're not being able to scale up the way some of their competitors are doing. It is a very competitive space, right, at the end of the day. And now the tie-ups that they have for these larger brands, which you talked about, they are great from a long-term perspective, but they will never be able to generate the same revenue growth that some of the low-ticket margin products have been able to generate. And profitability for some of these products will be dependent on how much they can scale up and at what level they can scale up. Because, look, selling something for, I'm just giving an example, you may sell something for 2 lakhs and make a profit of 1 lakh. But if you're only able to sell 5 pieces of that, that really doesn't add value, because at the end of the day, I mean, on the gross level, I'm talking, there's an operational cost and you're not able to scale past that operational cost. Given that, I feel the lower end, which is growing, the likes of Westside, Trent, have been doing really a lot better. The affordability has been there, and because that is there, I think those businesses will grow. So unless Pantaloon is able to turn around those operations, which I haven't seen in the fundamentals, I would avoid it for the time being. Even though all the prospects look really bright, I would like to see them first translate into numbers.
Got it. Well, the next question is from Shashi, and her question is on Cochin Shipyard as well as Garden Reach Shipbuilders, both purchased at 2,500 levels, and she wants to know whether, what should be the strategy going forward. Rajat, I'll come to you for this one, for Cochin Shipyard as well as Garden Reach Shipbuilders.
Yeah, as of now, both the stocks are in a downtrend, but I would say that the correction is mostly complete. Maybe there would be a little more fall. Say, Cochin Shipyard can go down to 1,400. Garden Reach may also go down another 5% or so. But if you are really interested in buying different stocks, these stocks have corrected themselves quite a bit. So I would say buy on dips should be the strategy. Say a very good buying level would be 1,500 for Cochin Shipyard. Similarly, after a 2-3% downswing in GRSE, you can get into that, Garden Reach Shipbuilders. Both these stocks, from a longer term point of view, I would say that charts are pretty good, and the much needed correction has already happened. So one can start accumulating from current levels, but buy more once it comes close to 1,500 for Cochin Shipyard. That is roughly about 5%, and the same around say 5% from here you buy GRS.
Yeah,
absolutely similar patterns.
Absolutely, and the drop has been quite sizable, as you pointed out, over the last 3 months. Quite a lot of interest, though, in Cochin Shipyard this week, for obvious reasons. Mithu from Gwalior is asking about IRB Infra InvIT, and this is an interesting question because the stock it's trading at 66,000 shares of what has been acquired. Of course, on the fundamentals, Sameer, this is something that you would buy into, thinking that you would look for long-term distribution of income. So it forms a part of your portfolio. Would you suggest holding it for a period of what, 6 months, 2 years, or would you think much longer?
So I don't have coverage on IRB InvIT, but if someone is looking to hold an InvIT, I would think it makes sense to hold it for a 2 to 3 year period. From a simple perspective, like I said, I don't have coverage on IRB, but what I'll say is when interest rate cycle starts heading down, these InvITs are giving you a particular return, right, which is more or less determined. But in the case of IRB, because these are road projects, their toll revenue keeps rising. It's not like a fixed basis in case of Power Grid or some of those other assets where everything is fixed. So if you have revenue rising from the tolls collection because the use of those roads increases, plus you have interest rates coming down, I think the yield to the current holder would start looking really attractive and the pricing could move up. So even though I don't have coverage, I say you can hold for a 2 year period. But for me, I much rather go in for a real estate InvIT, which you can get from there are a couple of them listed. Then there is also Bharat Highway, which is actually quite interesting, which is something that we have looked at and we kind of like. So I would say this is a good time to get into InvIT, but no coverage on IRB.
That's the view coming in for IRB InvIT, to be very specific. But with that, it's time to slip into a short break, but don't go anywhere. We'll be right back with more queries. Welcome back. You're watching Ask Profit, a show where we answer all your stock-related queries. For viewers who are just tuning in, you can ask all your stock-related queries on the number that's flashing on your screen, as well as on any other social media platform of NDTV Profit. The next question is from Vandana from Karnataka, and she wants to buy Ircon International at 220, and she wants to understand whether this is the right time to enter Ircon International or not. Rajat, I'll come to you with this one, your view on the company.
Well, Econ International, after peaking out around say 350, then it has come down, posted a low close to about 200 and currently trading at 220. Now, its 200-day exponential moving average is at 231. And for the most part of this, most part of September and current month, that is October, it is trading below the 200-day exponential moving average. Unless it takes out 240, it is not going to be a technical buy. But if one thinks this way, that I would buy here a part of it, one can do that. And above 240, you buy more. But please keep a stop loss below 200 in case you are buying now.
Cello World, I'm looking at the price. It's currently at 869, and Dhruv Parekh has bought at price of 754. 43 shares he's got of this company. Samir, coverage on this one, and what would you say? I must say I'm not very familiar with what they do. Samir, can you explain, if you have coverage, what they're doing?
Sadly, I mean, I know what they're doing, but unfortunately, I don't have coverage on them, so I don't want to comment.
They're in the, the boxes and all of that, right?
The glassware.
The glassware.
Yeah.
Okay. Rajat, do you have a view on Cello?
Yeah, technical analysts can give you view on any counter, at least looking at the chart.
That's what I depend on, Rajat.
Yeah, right. In that case, again, this stock is also testing its 200-day exponential moving average for the last 1.5 months, and currently it is trying. In today's session, it did go below that and again bounced back. Currently 869, but unless it crosses 925, there will not be any sustainable up move, because it is trading between say 860 and 925 for quite some time, maybe since August or so. So unless that level is taken out, there would not be any major movement in this. One thing I would like to comment here, Suomotu, I would say, that is, while answering your questions or all the stocks that you are putting it to Samir, most of the stocks are testing their 200-day exponential moving averages. So what this means is that we have reached a juncture where either we bounce back from here, correction is over, or else we are in for hard times.
That's a very fair point that you're making, Rajat. And in fact, considering the kind of drop that we've seen from elevated levels for both the benchmark as well as the broader markets, this is actually something that will be witnessed, I think, across the board. Correct me if I'm wrong, Rajat. What they say is 5% is a pullback, 10% is a correction. We are currently at a pullback.
You can say it's a pullback, but one thing I would like to say here is that I was rereading my Manias, Panics and Crashes by Charles Kindleberger. Now it is in the 7th or 8th edition. What it says is that if funds that come from other shores starts leaving, the country is actually going into some kind of a problem, because for the last 200 years, if you look at the history of such things, funds flows and what has happened going forward, it has been the same all the while, or in all situations. Whenever this thing happened, there had been problems. So I would say, whether you say that it is 5% or 10%, that's not the thing. The thing is that this humongous selling by the foreign portfolio investors should stop. People have a misconception that the SIP Sahi Hai brigades. See, one thing, there is somebody is giving support. 64,000 crore sales in a particular month by FPI, 63,000 something crore by the domestic mutual fund. Isn't it that we are always trying to back it up by more purchases that those people are? But those people are leaving our shores. Why that has to stop. If it doesn't stop,
Point
then
taken.
there will be problems.
Just to drive home this point, and this is actually something that a lot of people have spoken about. I'm curious what you think about this, Samir, because ultimately the trade that everyone's talking about is moving out of India and moving into China. And it's not like China has not got problems at this juncture. Of course, we don't study it as much as some other people do, but we've had so many people talk about the fundamental growth story that is India, and we're talking about the fact that earnings by and large are supportive of the valuations that we're talking about, right? So there is no structural problem per se in India that is resulting in this move away from India by foreign institutions. The question is, will the liquidity drive from the domestic investors continue to prove to be a bit of a support? And the math that we're talking about is mutual funds sat on 1.5 lakh approximately of cash at the end of September. They've bought about 75,000 crore worth of equity net basis in the first couple of weeks of October. So therefore, one would assume that they've got, 75,000, and they've probably added about 30,000. So they're sitting on about 1 lakh crore worth of cash right now. Is that a decent way to look at it, to say that there is still support for selling?
Oh, absolutely. I think there is some support for selling, right? So what you rightfully said, I don't think we have a structural problem at the moment in India. Whether it comes about going forward, that we'll have to keep monitoring. Now, to address the two things. First, we discussed the fact that they bought 75,000 crores. But the 75,000 crores need not only be your mutual fund industry. There is an insurance business. There are these pension funds which are also investing in equities, right? So we do not know what percentage of the portfolio has been invested by mutual funds and what has come from other sources. It could very well be that only mutual funds have put in 50,000 crores and they're still sitting on 1 lakh plus the 30,000. So they're sitting on a 1 lakh 30. Now, I agree with what Rajat said 100% that we hope that the FI selling subsides a bit or reduces. Because if they keep selling, we are giving these FIs an exit at a very elevated level. So what has happened is valuations have moved up, right? Earnings are no doubt growing, but the valuations have moved up far higher. The PE expansions, the price to book expansion, well, price to book in banking has not happened, but PE earnings for a lot of other things has happened, and we are giving them exits at higher level, which is a scary situation because generating returns for these investors who are buying right now is going to be a little tough. So I take your point that yes, structurally there's not a problem, but if the FI for selling does not sell, like Rajat rightfully said, it is a problem. Now, coming to the second point which you said is that people are selling India because China is an opportunity. I think globally there is so much liquidity still. I don't think it needs to be looked at as India or China. I think you can do both. It's just that because of the geopolitical issues, which can affect India a lot more, because at the end of the day, our biggest import is crude, and if crude prices move up because of Middle East tension, that is a big negative for India. So on that basis, I think some FI selling has happened. I don't think it's purely this money coming out from India and going all of it to China. I think there's enough money in the international markets to go. There is some amount of risk aversion which has taken the money out from India, and maybe some amount has gone because of the India-China trade, but I don't think that's a significant part of the overall trade.
Yeah, I'm sorry to everybody who's written in with their questions to have diverted this into that conversation, but I think it's still important to have addressed this important point being made by both Rajat as well as Samir, both in terms of the technical indicators as well as the valuations. Let's move to the next question, though. I believe it's from Raghavendra.
Absolutely. So it's from Raghavendra, who's from Karnataka, and his question is from for Reliance Power. He bought it at 13 rupees a piece, and he wants to understand whether he should sell now or hold this particular stock. The stock is currently trading at 43, so he's almost tripled his profits by now. But Rajat, your view on this one, whether he should keep holding it or he should sell it?
I would say that it is really a difficult proposition for even a technical analyst for a stock that moves circuit to circuit, because that means there is scarcity of shares available for people who are willing to buy. And when it falls, then also gap down circuit sometimes. Today it is showing some recovery, and it might again move above, say, 45. After that, there would be some more traction. But for a stock of this kind, if you are gaining 3 times, unless you are very greedy, at least book part profits. If I were you, I would have booked at least 50% of the profits out here so that I don't have to face any kind of drawdown on my capital. My capital is already secured if I book 50%.
Covered your buy price or your cost price. Let's talk about KFin Tech. It's a stock that has doubled in the last year. In fact, in the year-to-date period itself, it is up about 120% or thereabouts. We've got a question from Muiz Ansari, who's asking whether it can be bought at the current juncture and what the long-term prospects are for this counter, specifically for the next 10 years. So, Samir, if he buys right now, he is in no hurry to sell. From that perspective, would you suggest a fresh entry at this point?
Okay, fintech, yes, I would. But again, if you look at the business model, I mean, if you look at another company in the current same space, it is Computer Age Management, which is CAMS. I think they have a larger share of the market, and the growth also there is going to be a lot quicker. So if I had to take a pick, yes, valuations for both are expensive, but since he's given a 10-year view, I think the growth opportunity is immense for these businesses. Again, no further real capital addition or strong operating leverages. The mutual fund industry is going to keep growing. The insurance industry is expected to come onto their platforms to where they are going to have a certain amount of revenues that they can generate from that because it's going to be dematerialized. So there's a lot of opportunity in that space. I think it'll do really well. If you are hellbent on KFin Tech, yes, you can buy it. But my preference in the space is CAMS.
Got it. The next question is also for you, Samir. It's from Sambhunath from Kolkata. And he wants to understand whether he can take a fresh position in LTTS. It came out with its earnings recently and did post a growth of around 8%. So, and he wants to understand whether he should invest in LTTS from a 5 years or more term horizon. So, your view on the company?
Okay, so I am positive on the fact that the entire IT space and especially the space that LTTS is catering to is going to keep growing. The problem is, I think the near term is going to be a little difficult for these companies because there is we can see a bit of a slowdown happening in the US and the European markets, which are the largest markets. And you can see that across the board, which is why you're also seeing a correction. Also, valuations in the past have moved up for the entire space, right? People are factoring in that, look, these are cash-rich companies generating cash. Profits will grow. Eventually, the US and the European markets will rebound. The business opportunities there. And with the automation angle taking up in such a big way, LTTS, which caters to that space, will continue to do well. But I believe that till valuations come to more reasonable levels, I would not be in a rush to buy. I believe the long term, the next 5 years will do really well for this company. But I think corrections, it's not small correction. I'm not talking of a 2% correction would be a buying opportunity. I would talk of a 10 to 12 to 15% correction. And I believe that can happen over the next 3 to 6 months, maybe a year. And that would be the right time to get in. If you want to keep nibbling and adding, that is not a problem. But the bigger chunk should come at much lower levels.
Point. Gentlemen, it's time on the program to slip into the rapid fire segment. You've both done this before, so just for everybody else tuning in, 2 minutes is what we have left on the query space, and we will try to address as many questions as possible in that time. The first question is coming in from Saurav. He's asking about Balrampur Chini Mills, which he's bought at price of 404 rupees per share. He's asking whether to hold or should he sell. He's in the green right now, so the question, Rajat, is should he sell?
Yeah, I would say that one should sell. It is better to sell because it has moved up and now it has posted a lower top and it is again testing the short-term bottom. So I would say sell.
Okay.
The next question is from Sheshu John, who's from Cochin. Should I hold my 1500 SpiceJet bought at 72? Rajat, your view on SpiceJet?
Well, I would say that one should get out of this stock because this is showing selling at every rise. Whenever any rise happening, people are selling it. So better steer clear of it. Go to somewhere else.
Okay. Quicker answers, gentlemen. M&M, would you buy at the current price? Shankar from Bangalore wants to know. Samir, would you buy on the fundamentals?
I wouldn't buy, I would hold it, but I would wait for corrections again closer to 2,600 to buy.
All right, the next question is from Jaya from Bangalore. She wants to know a view on Hutco and Orient Tech. Both of these companies, Samir, your view?
Hutco, I would sell. Orient Tech, no view.
Ambuja Cement, average price of 260 rupees per share. Rekha wants to know whether to hold on in the cement space. Is this the best pick according to you, Samir?
No, it's not the best pick. I would not hold on to Ambuja Cement. I think Shree Cement throws up a good buying opportunity, and so does Madras Cement.
Right. Rakesh from Ahmedabad wants a fundamental view on transformers and rectifiers for the next 1 to 2 years. Samir, I'll come to you again for this.
No view on this one.
Okay, Sequent Scientific. Let's pull up the chart. 228 is the buy price. Sushila wants to know about whether it should be held on to. Raja, on the charts, what's the view?
I would say hold on to it, but put a stop loss below 170.
Okay, all right. Gentlemen, thank you so much for joining in, for answering all the questions that you did answer. And by the way, we did take a question on Ambuja Cement's a standard disclaimer there. This is NDTV Profit. You are watching, and it's part of the NDTV Group, which is owned by the Adani Group. Gentlemen, thanks so much for taking the time. Always a pleasure having you. All right, now let's talk about Quick Heal, which is a stock that has been in focus today. It has lost ground on the back of earnings and quite a deterioration if you look at it on a year-on-year basis in the margins. I believe that there is a 10 percentage point fall in the margins on a year-on-year basis. Erosion has occurred on account of an increase in the employee costs, which account for a sizable chunk of the cost for the company. The stock is down about 6.5% as we speak, and Rucha has spoken to the management. Let's see what they have to say.
Thank you. So quickly reported their numbers. Well, quickly speaking of the numbers, revenue from operations were down 6%, EBITDA was down 73%, and therefore the margin came in at about 4% versus 14% same time last year. Net profit was down 68%, so badly beaten in terms of numbers. Well, this was majorly, the margins were hit majorly because employee costs were up 20%. Now, talking about the historic mix, when we spoke to the management mentioned that their focus will turn from consumer side of the business to the enterprise side of the business. And when we look at the trajectory, well, 20% is to 80% is what was the enterprise versus consumer mix. But this has now increased to around 40% to 60% in terms of enterprise and consumer. So largely, yes, we can see that the focus towards the enterprise business has grown. Now, talking about the cloud and the non-cloud business, well, here also the company mentioned that they will focus more on the cloud, and from 17% in FY23, the business is now 28% coming from the cloud segment. So yes, the company has done what they have said, but bad numbers is what they're taking the stock down. Well, the conference call is happening today at 4 p.m. wherein we'll get more highlights from the company. But quickly speaking of the stock performance, well, stock has done tremendously well, up about for 142% in last 1 year, and in last 6 months it has grown 51%. Now, a few recent announcements include the fraud.ai, which the company had announced, largely protecting the fraud with the help of the AI is what the company had announced. But we'll see more updates coming in from the call today.
Rocha, stay with us because, Wipro has been the sole gainer in the tech space today, though the IT sector overall has taken a significant hit. And, you took a right call in the morning also, giving the stock a thumbs up. So give us more detail on what's happening with Wipro.
Yeah, thank you so much. So Wipro is doing well in trade. Numbers were really good. While talking about the numbers, revenue was up about 1.5%. Margin came in largely flat. Net profit was up about 6.8%. One negative over here is that the guidance came in below the street estimates. Well, the guidance implies a negative 2% to flat in constant currency terms for revenue growth in the third quarter. This was estimated at negative 0.5 to 1.5%. So a bad miss on the guidance expectations. But what is moving the stock is the bonus issue. Well, the bonus has come out. The company has announced 1:1 bonus, and many people on the street are expecting a turnaround from Wipro under the new management, and this could be the initial signs from them. Well, talking about deal wins, large deal wins were highest in last 10 quarters in the second quarter. So this is another positive why the stock is going up. Well, people metrics is largely recent. Voluntary attrition was flat at 14.5%. Added around 978 employees. So positive hiring is also an indication that demand is picking up. Well, the company in the conference call mentioned that the Wipro, that is the consulting side of the business, which is largely related to the discretionary spending, is also picking up. So another positive is what we could see over here. Well, we'll talk about what brokerages are saying. Well, in terms of Wipro, we have both bull and bear case. Well, in terms of bull case, we have Macquarie, which has maintained an outperform rating with a target of 670 rupees and upside of around 26%. Now it says that management is, although attributing muted growth due to furloughs in the second half, it will continue to expect an improvement in the growth helped by improved competitiveness, is what the brokerage house believes. And it also believes that the demand for the whole sector will pick up in CY, that is calendar year 25. But on the bear side, we have Wipro on Kotak, which has maintained a sell with a target price of 500, downside of around 4.3%. Now it mentions that downbeat in guidance for the third quarter is disappointing, as I had mentioned earlier. But overall, sector-wise, also the brokerage house stays cautious, and it also stays cautious on the turnaround outcome. So turnaround outcome under the new management is not really sure, is what the brokerage house is expecting.
Got it, Rucha. Thanks so much for getting us that view. Let's talk about Polycab, because a stock that was under pressure, considerable amount of pressure earlier on in the session, it has recovered some ground from that point. It's trading with cuts of about 2% on the back of earnings. And Mahima is tracking this closely. Mahima, not the best numbers to speak of. Again, erosion in the margins are a bit of a problem, right?
Absolutely. So margins for Polycab have gone back to where they were in 2022, which is why the stock has tanked so much. In terms of revenue, they had a good growth of around 30%. EBITDA also was, quite a good growth. But margins is where the pressure is. Now, there are multiple reasons why this has happened. First one being there's higher mix of B2B and institutional sales, which has overall impacted the margin, because that is,
margin business.
Correct. And then there has been lower mix of exports. Now, their exports in terms of total revenue have come down to 6% versus that of 9%. And exports is a high margin business. So this is one of the major reasons.
But is this going to be durable? Because one would assume that if there is a shift in the volume mix, or not the volume, but the business mix, it's something that is durable. It's not something that will change so quickly. So one would assume that the margin profile is going to change completely.
Absolutely. And I think, absolutely. I think it will take time for them to, come back to the 14% level, which they had in FY24. Now, one more reason, because the margins have taken a hit, which management has said, is that they're facing intense competition in this space. And of course, they are continuing to invest in category and brand building efforts, which is one of the reasons why the costs have gone up and margins have taken the hit. Now, just a view as to how the margins were, FY24 around 14%, FY23 also they were around 13%, but FY22 were between 10 to 12%, which is why I said that they've come back to the FY22 levels. Now, exports are declining. They've declined around 29% YOY. In terms of other key highlights, some positivity in the results. Revenues grew by 30%, where the 5-year CAGR has been around 20%. So good growth there. The cable and wire revenues also grew by around 24%, where the CAGR is around 24%. So again, something positive, to look out for in Polycab. But overall, brokerages have not remained too cautious about the stock. Jefferies has maintained a buy with a target price of 8315, and they've made a minor EPS tweak of around 1 to 2%. FY24 to 27 estimates of sales and PAT CAGR are around 21 and 22%. And overall, they retain target of PE at 42 times. So this is the overall view of why, of course, the Polycab stock as a stock has tanked today.
Speaking of stocks that have not done too well, a couple of pair in the gas distribution space, MGL as well as IGL. These are both counters that are under tremendous amount of pressure, and this has to do with a notification that was sent out overnight, of course, that talked about a shift in the sourcing of the gas that is going to have a bearing on the profitability of the companies. Varsha is joining in to tell you about what that announcement was. And it's not new, right, Varsha? It's something that came, I believe, a week back. But the notification that was sent to the exchanges overnight about the implications for the bottom line was what triggered the selling.
Yes, Alex, you're absolutely right. So you're seeing Indraprastha Gas, Mahanagar Gas and Gujarat Gas under selling pressure. Now, Indraprastha and Mahanagar gave out a statement in the exchange filing that they'll see impact in their profitability. Now, so technically, India's city gas distribution sector is actually facing challenges. Now, there was this 20% cut in gas allocation through APM, that is Administered Price Mechanism, have raised these concerns. Now, the domestic natural gas allocation for these companies has been reduced to 21% for IGL and 20% for MGL. Now, what this means is the natural gas is actually the key raw material for these distributors, and reduction for the same will actually affect the profitability, and companies need to import remaining gas which costs 50 to 60% more than domestic gas. Now, without increasing the CNG prices, company may see risk in margin losses and reduced profits. Now, price hike of ₹5 per kg in CNG segment is expected to maintain margins. However, this could lead to lower volumes. Now, this is as per the city, and if there is no price hike, then earnings could drop for IGL, MGL and Gujarat Gas. So this is all the reason that we are seeing, pressure on these stocks.
Right. Thanks so much, Varsha, for getting us those details. That brings us to the end of this particular edition of Ask Profit. As we speak to you right now, there's been a change in the texture of the market. You have gains of about 0.33% for the benchmark Nifty 50, and you have the mid-cap index that's just about in positive territory. Let's see if that continues towards the rest of the session as well. But from Mahima and myself and the team that put this show together, that is all for today. We'll see you on Monday again. Do stay tuned. This is NDTV Profit.